Welcome to the DebtCircle podcast. Today is May 12th, 2026. Hi, I'm Vijendra, and we are ready to dive into some critical topics shaping the debt market right now.
And I am Leela today. We'll be discussing how to evaluate unlisted bonds before you invest, Franklin Templeton's latest debt strategy in India, pressures in the banking sector, and several major developments shaping India's financial landscape.
Unlisted bonds offer double-digit yields but demand rigorous credit evaluation. The key is assessing the issuer's cash flow and repayment ability, not just chasing a 14 or 16% yield. Structural details matter hugely, because a secured bond with enforceable collateral differs vastly from unsecured or subordinated debt.
Right, Vijendra. Investors also face limited liquidity and no active secondary market. These are hold to maturity plays with uncertain exit options. Plus, post tax returns often fall short of headline yields due to slab taxation. So, risk and return must be balanced carefully.
Franklin Templeton India is reducing equity exposure from 90% to 60% over the next 3 to 5 years, focusing on medium to long-term corporate bonds and money market instruments after raising over Rs 500 crores for credit alternatives.
That's a strategic shift, especially when March 2026 saw equity inflows of over 40,000 crore rupees, while debt funds witnessed outflows close to 3 lakh crore rupees. Investor confidence in fixed income still remains fragile after the 2020 liquidity crisis.
Franklin Templeton also faces intense competition from domestic leaders like HDFC Asset Management with a price-to-earnings ratio around 42.85 and ICICI Prudential near 51.14, making fixed income growth increasingly competitive.
At the same time, emerging global players like Geo BlackRock are entering the space, meaning fund houses now need stronger strategies to balance investor confidence, credit alternatives, and long-term portfolio stability.
Capital Small Finance Bank's deposits crossed Rs 10,018 crores by March 2026, with over 90% coming from retail customers, supporting a CASA ratio of 34.7% despite ongoing liquidity pressures in the sector.
That CASA ratio is important because the broader banking sector's average has declined from 44.8% to 37.9%, pushing banks toward costlier deposits and increasing funding costs, particularly for smaller banks.
On the lending side, Capital Small Finance Bank's gross advances rose 20.9% year-on-year to Rs 8,687 crores, while gross non-performing assets remained at 2.54%, reflecting stable asset quality.
Still, competition from fintechs and rising funding costs mean small finance banks will need to manage credit growth and profitability carefully as the Reserve Bank of India keeps the repo rate steady at 5.25%.
State Bank of India is hiring 4,000 new staff members to form a dedicated loan collection team focused on early-stage stressed loans, helping protect asset quality as the bank's loan book expands.
The move aligns with the Reserve Bank of India's expected credit loss norms. Despite a 5.6% rise in profit to Rs 19,684 crores, SBI shares still fell nearly 4% because of margin pressures.
GE Power India posted a sharp turnaround with fiscal year 26 profit before tax soaring to Rs 3,399 million from Rs 224 million last year, while income climbed 23.7%.
The EBITDA margin before exceptional items also jumped to 27%, while earnings per share rose to Rs 45.53 from Rs 3.34, highlighting major operational improvement and stronger investor confidence.
Bank of Baroda is targeting 10% growth in its corporate loan book, currently at Rs 4,56,000 crore by fiscal year 2027, driven largely by strong demand for term loans.
Demand from sectors like renewable energy, steel, and infrastructure remains strong, while the bank's floating provision buffer of 1,500 crore rupees is helping maintain stability amid changing accounting and regulatory conditions.
South Indian Bank's gold loan portfolio surged 46% year-on-year to Rs 24,729 crores. Although the Reserve Bank of India's stricter gold loan rules effective April 1st are expected to slow future growth.
Those new rules include stricter loan-to-value ratios, tighter verification, and limits on consumption loans capped at Rs 2.5 lakhs, all of which increase processing timelines and reduce quick disbursals.
SEBI's proposed Green Channel will allow certain alternative investment fund schemes to launch immediately upon filing, reducing waiting periods from 30 days to 10 working days in a market now exceeding $150 billion.
That's a major boost for market liquidity and faster capital deployment, especially as accredited investors in India have already grown more than 327% within a year.
Indian government bond yields also moved sharply higher, with the benchmark 6.48% 2035 bond closing at 7.0317% amid rising crude oil prices and ongoing United States-Iran geopolitical tensions.
Since India imports nearly 90% of its crude oil, higher energy prices continue impacting inflation expectations and overnight index swap rates, increasing expectations for tighter monetary policy in the months ahead.
From NABFID's AAA-rated infrastructure bond issue to major updates involving Kotak Mahindra Prime, Canara Bank, Birla Corporation, Yes Bank, Aditya Birla Capital, Brookfield India REIT, and several leading issuers, one thing is clear: India's debt markets are evolving rapidly, and investors are closely watching credit quality, liquidity, infrastructure financing, and interest rate trends. That's all for today's episode of the Debt Circle podcast. Stay informed, stay invested, and we'll see you next time.